Is the Fed going to tank the market, or are we on the cusp of an epic bull rally? This video is going to cover just that, what to expect from the Fed and what we can do with those expectations. Before that, for those of you that don't know, my name is Wolf, and for those of you that do, thanks for checking me out again. This video is intended for educational and informational purposes only, and it's not financial advice. If you're looking for financial advice, please talk to a financial advisor. We're going to jump right into it. There are three things that I want to cover first. Inflation, the job market, price stability. The Fed consistently touts inflation as the root cause for why they do anything. It's why they take any approach, why they pause, why they punt, why they raise aggressively. This one's pretty easy. The Fed consistently says that they're trying to get inflation back down to their 2% target. Remember, the Fed has a dual mandate, which they're looking for maximum employment, that's the job market side, and inflation down to 2%. That's their target rate, right? So I've argued previously that the Fed will pivot, but their pivot won't come in the sense of punting on rates. It'll come with them anchoring their 2% target higher, but we'll cover that another time. The job market aspect of this whole equation is looking for maximum employment as the Fed defines it. So in previous meetings, the job market has been hot, and the Fed has explicitly stated, Jerome Powell himself, that there were 2 jobs for every 1 applicant multiple times. That's been a root cause for why they've taken actions in the past. So this meeting will be interesting because recently we've gotten some cooling jobs data for the first time in some time. So it will be interesting to see how the Fed kind of absorbs that information and how they'll relay that back to the market. Are they going to be consistent with the fact that inflation itself hasn't cooled as aggressively as it has in times past? So it seems to be a little bit more sticky right now, relatively. Or are they going to focus on this job market aspect where jobs themselves seem to be loosening a little bit, and that tight labor market that he keeps referring to seems to have calmed down a little bit. So to reiterate, the Fed's dual mandate of 2% inflation and maximum employment is the rhetoric that they use, and it's all around the term price stability. So we'll see if the softening data that we've seen in the jobs market and the inflation data that's happened over the course of the last 9 months will be taken into account when they talk to us tomorrow at 2 p.m. So the imbalance of price stability that we're looking for is the why, just going to touch up on that real quick, is the why the Fed takes any action that they take. And so they'll cite this price stability as a root cause for why they're taking any particular action that they are taking. Moving along, we'll go to a direct quote from Jerome Powell where he says, "My colleagues and I are acutely aware that high inflation is causing significant hardship, and we are strongly committed to returning inflation to our 2% goal." So in the previous slide, I talked about how I believe that at some point they'll take that 2% target and anchor it a little bit higher and say there's a new normal, and that's going to be the pivot. That's still my belief today based on the circumstances that we have. But until the rhetoric itself, their 2% target changes, that's kind of like the benchmark for what we're looking for, right? So that sets us up for the odds. So before I talk about the odds, let's talk about seasonality. So far, September is living up to expectations, right? So we know historically that there's a September effect on markets, and that September effect leads to markets underperforming. We can argue about why that is. Many people have different reasons for that. But historically speaking, September is the worst month on record. And we're kind of living up to that so far. And, it's not going to sound too crazy, but when you juxtapose it with the conditions that we've had prior, it will kind of make sense here, right? So in 6 of the first 12 trading days of this month, the S&P is closed down. And that's not the interesting part. The interesting part is that in every single one of those down days, the market's been, quote unquote, so weak that it never traded in positive territory. So for 6 of the first 12 days in September, we've seen the market go down and not go green at all. And that's kind of like a different aspect or a different way that the market's been performing relative to what it was in the past, right? So if we go back to prior months, you might start the day red, finish green, or finish flat, or whatever. We talk about the pancake, in the Discord and all that stuff. It's a constant pancake. They're constantly bringing the market back, compressing it back to zero, flattening it out, or taking it green, or whatever the case may be. But in this case, 6 of the first 12 days, they couldn't do that, right? So, but that said, and this is where it's going to sound, where I said it's going to be a relative thing. So with that said, the market's only down 1.4% for the month, which is like a good 20-minute period, right? So it's good to know, where we are on a relative basis, which is we're relatively weak compared to prior months where we can't maintain those highs. But on a positive note, we're only down 1.5%, which could be erased in like 20 minutes on a positive headline. Now that said, there's a 99% chance of a pause. It's important to set the stage. Going into today, there's a 99% chance of a pause. I cannot reiterate that enough. Historically speaking, there's never been a time where the watch tool prices in more than 80% and the Fed doesn't do what the watch tool suggests. So historically, we're going to have a pause because historically there's a 99% chance of a pause, and we don't ever do it. They don't ever do anything different than what's suggested above 80%. But the important part here, in my opinion, is going to be whether or not the Fed aggressively indicates whether or not they're live for November 1st and future dates, and whether or not they're saying that they're pausing and they like the conditions. So again, the tone and the words used are going to be more important than the decision tomorrow. But secondarily, any aggressive hint to a November 1st live hike, or if there's ammo in the chamber, then they can go hike, then it will be a negative thing for the market. And the reason I say that is currently there's only a 29% chance for a hike in November. So anything that's contrary to that belief will set things pretty aggressively to the downside or create a little bit of panic in markets, in my opinion. And I'm using the word panic here a little bit loosely. I'm not talking about a crash or anything like that. But I'm just saying, with the VIX sitting at where it's sitting at and with the way the market's been participating the last several months, any strike of any match could kind of cascade things a little bit aggressively to the downside. So there's a current tug of war between positioning and the underlying macro. And so in the previous slide, we kind of talked about any little thing could spark things between, now and when the Fed speaks. And the reason for that is this entire year has been a tug of war between the macro deteriorating, which is, and go back to this time, not last year, you had everybody and their bearish brother on Twitter telling you the sky's going to fall, right? RIP George Noble. But heading into this year, we had very peak bearish positioning and historical volatility that needed to kind of unwind. And so the current scenario that we find ourselves in is a push-pull between that unwind of volatility, which was in positioning that we had this year, and, the macro people being like, hey, the sky is actually going to fall, guys. The bond market screaming at the equity market, like things aren't good, right? And so we've had this kind of like push-pull, and the Fed has kind of gotten what they wanted. We've had inflation kind of come down, not kind of, it has come down. It has cooled. You've kind of had this Goldilocks environment up until this point, and it's allowed for positioning to unwind and for the bearishness to kind of subside, and then the bullishness to kind of take place while we see things calm down and cool. Now that said, that soft landing rhetoric that the bulls have been aggressively praising kind of comes on a little bit of a watch here with, inflation potentially being stickier than they expect, right? So the current scenario we're in is one where we have a weak seasonality in September. We have, kind of complacency in the market itself and some lack of volatility across the board. And it just takes, one or two things that kind of push it one way or the other that will give a little bit of ammo to the bears to kind of push things back the other way, especially with positioning having unwinded the entire year the way that it has. So to wrap it up, I'm going to read this real quick. The important part will be whether or not the Fed will be aligned with the inflation data as a headwind, specifically whether or not the PCE being sticky kind of rears its ugly head for them, or if they'll use the, quote, cooling inflation as a path for, quote, soft landing. And then secondly, it'll be important to hear where the Fed and their dot plot will target rates in the coming 6 to 12 months. Are we going to have a even higher for even longer scenario, or is this going to be like things are Goldilocks and we're going to hit our soft landing and, going into an election year, things are going to be rosy for the Fed? And then secondarily, for the soft landing aspect, bulls, again, have been aggressive in their praise that the Fed will, in fact, be able to pull this off. And the argument against this is going to be that positioning, in fact, is driving the market, not the data. So when the data turns, it'll be kind of aggressive and it'll catch people off guard. And there's a line about bankruptcy. How do people go bankrupt? Slowly and then quickly. And that's kind of the same concept here. How do things break? Slowly and then quickly, right? And so that's kind of been the push-pull, and that's the push-pull that we're in right now. Although, again, seasonality speaking, you can't break it beyond September. It's going to be tough to break it going into the end of the year, but we'll get to that in a second. So the things to consider, giving you a little acronym here, right? So POSI, positioning, oil prices, seasonality, and yields. And so I chose these things because first and foremost, again, positioning had been so bearish into this year that it didn't take much to unwind the bearish sentiment, right? And so secondarily, oil prices are a main pain point, and they can throw a wrench into the Fed's plan. So right now, everything is set up Goldilocks for the Fed. They think they've got their inflation under control. The job market's showing a little bit of slack, and it's setting up for things to kind of play out positively. But if oil can get above 90, WTI can get above $95 a barrel, it's kind of where the inflection point starts to cause persistent pain. And that's just my opinion. Problem is that it's not higher energy prices as an economic issue. It's about inflation in general. So if the Fed's telling you that this is what they're looking for inflation to cool down, and we've had this inflation kind of cool to this point, but let's just say that hypothetically it just stays stuck here, and because there are some tailwinds for it to stay stuck here, then it kind of boxes the Fed in again, right? And so the problem again isn't higher energy prices as an economic issue. It's about inflation. And so their ability to become untethered with an upside inflection in headline inflation, and the Fed's game theory starts to get exposed, right? And so inflation expectations are linked more to headline inflation than to core data. And so energy, as a result of this, has an outsized impact on the inflation picture. So, just to put that very plainly, if energy can stay higher, it'll have a more drastic effect on the headline inflation than it does the core data. And so you can spin it economically however you want. Oh, our graphs say this or that. If things cost more, the Fed's kind of stuck again, right? And so the third one, seasonality. Again, we talked about this every slide so far. September is the worst month on record historically. If bears are unable to drive markets lower by November 1st, it doesn't bode well for them, right? So if bears are not able to do their damage now into November, it doesn't bode well for them. And that's where you get your little Santa Claus and you get this up market effects and all of that stuff. So again, we're in the worst seasonal month on record historically. And if they're going to break something, or if they're going to cause some damage, now would be the time. And the longer that it goes, the more likely that it doesn't happen. And secondarily, and simply put, since there's a lot of bearish positioning, on quarterly basis and going into the end of the year, it's just going to create some jet fuel, right? Especially with this wealth effect that people would have if the market's up and they need to reallocate their positions that they have, or if they need to reinvest some of this money that they've made. And the last part is yields, right? So this entire year, we've had this push-pull between positioning and macro. And again, this time last year, RIP George Noble, not literally, metaphorically, you had every bearish idiot and their brother telling you that the sky's going to fall, and there's nothing that's going to stop it from happening, right? There's tunnel vision on the fact that the market was going to collapse, and there's nothing that was going to change it, right? So yields have kind of been, that was one of the things that people pushed to last year, and it's the thing that still gets pushed to today. Every bond yield on the curve except 30s closed on the decade high today, right? And so the bond market's still telling you eventually shit's going to hit the fan. But currently, market's kind of ignoring that and hoping for a soft landing, and maybe the Fed pull it off. And that's kind of where we're at. And the last thing I'll say about yields is, and I've said this in multiple videos before, historically, you will get kind of like a blow off in yields on a short run, on the short-term bonds, 2s, 10s especially, and you will start to see a drop in those yields first, followed by a drop in the market, right? So historically, you'll see the blow off, you'll see them come in, and then you'll see the market follow. And that's typically where you start to see that happen. We've never historically seen an instance where those yields have made new highs and that the market was still in an upcycle. Not saying that it can't be different this time, but I'm just saying improbable when you look at how things have been historically. And so that leads us, is it going to be this time? Is this going to be the break, right? So again, based on positioning, low volatility, and seasonality, we're set up for some sloppy action probably. But if things need to get unwound because it's sanguine and rosy, then we're in a situation where we've got a lot of negative positioning that needs to be unwound. So historically, again, terrible time. But if things perk up, it creates this jet fuel. But secondarily, it's kind of like everybody likes to talk about exogenous situations, right? So secondarily, if the Fed comes out and does something that nobody's expecting, right? So the Fed, historically, if the Fed watch tool is above 80%, then they do that thing that the Fed watch tool says. But if they just do something that the market's not expecting, so if they decide to pull a wild card and say, hey, we're going to be safe, rather be safe than sorry, we're going to hike 25 basis point. Now that negative positioning that everybody talks about and that I'm mentioning here, it doesn't get unwound. It becomes jet fuel for the downside, right? So if the Fed does something that is unexpected, it potentially could spook the market, and that can create that negativity that ultimately breaks things. But that's, again, they've never done that, so it would be kind of it would be out of character, but it is something that it's important to mention at the very least. So this slide that's on your screen is courtesy of Ryan Dietrich, and it's just basically, I don't need to spell it out for you, it just basically says what it says. The next 10 days are some of the worst days historically in the year. And so again, you can at Ryan Dietrich on Twitter. You could reach out to him and thank him for it. But essentially, we get on average a 1% negative drawdown, a minus 1% drawdown in the next 10 days, basically. And so that's the bad news, the September effect, right? The good news is, if you just take a look at October, take a look at November, take a look at December, you typically will have positive returns during those months if you've got a bull market. And so historically speaking, again, this speaks to if they can't break this between now and November, it really kind of sets up for a chase into the end of the year, and it sets up for, bullish sentiment until the beginning of next year, basically, where we can reassess based on positioning. But in the short run, the next 10 days, worst 10 days of the year. So we've got this, to recap, we've got this push-pull between the macro and between positioning, and that's been the case all year. You've got the Fed never acting rogue when you have Fed funds above 80% and Fed funds expectations above 80%, and they're above 80% now. You've got the worst month in the calendar right now, and you've got yields screaming something different than the equity market is. And lastly, you got the oil impacts that could potentially come if you get oil that stays stuck at this price higher. So those are the things that I wanted to cover on a short run. We're going to go over some charts now very quickly, and then we'll be able to just kind of wrap it up. Let's cycle through some of these charts. Right on your screen, you're going to see the Russell. So the Russell this year has been in a range, right? So it's been in a range between that 1730, 1740 level and 2020. So on the lows, we get to about 1735. Sometimes we undercut it, call it 1700 on the very low end, and it gets bought back, gets to 2000, 2020, gets sold off. We're right at an inflection point. We're at the inflection point for where we broke out in June, and then we retested in July. So we're basically right there. And if you're a bear, you're going to tell me this is a head and shoulders top. And if you're a bull, you're going to tell me, hey, we're just retesting that breakout, and eventually we're going to get back to those highs, if not break through them, right? So if you go from there, you go to the S&P. The S&P got to that 4,600 level where it topped out in March of last year, 2022, and that inflection point where we broke down in January of 2022. We toe tapped pretty much to the penny this uptrend that we've been in since we started going in March of this year. Now, I can show you in an hourly. It essentially just got right to that number and held. So that level, today's lows will be the level to watch tomorrow. There are 44.16 spot 6-1. So call it 44.15 will be the level to watch. Call it 44.10, you go to downside. If we take out those lows tomorrow on the back of something that the Fed says or the actions that they take or how hawkish they might be, you could potentially open the door for a 5% sell-off back to the 200-day, which would be the uptrend that we started last October and tested in March on the back of that SVB nonsense. So if we end up selling off, it really bodes well for that late year push, the seasonality push, and potentially a blow off, right? Secondarily, if you're bullish, you'll say, hey, we held this trend, and if things are sanguine tomorrow, you'll look for that 4,600 level to be tested and taken out. And if you take that out, you kind of got nowhere else to go, right? Like there's really not much in the way of that in an all-time high. And that goes back to what Croissant Man has been talking about, and everybody likes to echo. We're going to have this blow off, and that'll be capitulation event, and that's when things will get hectic. So again, if you're same kind of concept with the NASDAQ, right? So the NASDAQ basically is a stock market. The top 7 stocks make up like 35% of the market in general, and most of them are in the NASDAQ, blah, blah, blah. If you're a bull, you'll tell me this is a giant potential cup and handle. We're potentially going to blow out the top of this, and we're going to go into the new year, with the Santa rally. If you're a bear, you're going to tell me, hey, we were in this uptrend, we broke it, now we're kind of floundering around for the last, 3 months or whatever, 2 months or whatever, right? So it comes down to tomorrow's event. What's the Fed going to say? Are they going to be, focused on the unemployment situation being a tailwind for them and having a soft landing? Are they going to focus on that fear that, oil creeping back up and material costs creeping up and geopolitical tensions could potentially be a stickier inflation tailwind, right? So it just comes down to how they view it and what they're going to view and how they're going to act. Are they going to stay hawkish? Are they going to actually be aggressive? They're going to do something that people aren't expecting and give you a 25 basis point? I don't know. So that's what it'll come down to tomorrow. And with that, I want to say thanks. All right, that's the video. Thank you for watching. If you liked what you saw, please hit that like button. Don't forget to subscribe. If you found it useful, please share it. Leave me some feedback in the comments section or reach out to me on all social media platforms. I guess except Twitter, I haven't been on there in a year, at EveryTimeICash. Or you can reach out to me, everytimeicash.com/contact. If there's anything particularly you want to see in the future, please let me know. Once again, thanks for watching. Please stay safe, stay profitable, and stay locked in.